thank you everyone for joining us today. I'm MJ Martinez and I am Kenner's assistant. So I just sit here and kind of go behind him to say anything of compliance, which of course everything we say is for educational purposes only. And we do recommend that you get with your professionals for your specific situation. So this is what I do on a daily basis for Kenner. And thank you for bringing.
You better believe it. I love hanging out with you. Absolutely love it. It's been great having you on board. Since I've known you, you've added so much value, not only to me and my company, but so many entrepreneurs who we've been able to touch their lives so well. And guess who we are joined by? Ladies and gentlemen, the one, the only Techie to the rescue. What's up, Techie?
Hey, Kenny, and just like about to hop on a meeting, but I literally saw your notification pop up, so I wanted to say hi and welcome to Green.
I love it. I love it. Sounds like you have to get going any moment, but I totally appreciate you doing this. Matter of fact, this is a podcast that's going to be sent all over the world. Techie, you're going to be part of a podcast that's going to go all over the world. I know you have to go, but if you want to mention a little bit about what it is you do and how to get a hold of you, go for it, buddy.
Yeah, this is Techie to the Rescue. You can find me at techie2therescue.com. Help people understand their technology better and working on all kinds of crazy projects as we speak. And congratulations on the new podcast.
Sweet. Thank you so much. I know you got to go. I totally appreciate you being here. If anyone wants to reach out to Techie, he is an awesome guy to reach out to. Once again, we're talking about taxes and finance, but mainly taxes, strategies to lower tax liability for business owners. This podcast is featured by Vast Voices, which is the media arm of vastsolutionsgroup.com, a company that, again, uses tax, finance, and artificial intelligence to lower tax liability for entrepreneurs. MJ, you've heard what I typically talk about to help lower tax liability. What are some things that you think about that are important to entrepreneurs to lower their taxes? May it be, I don't know, retirement plans? May it be, who knows? Maybe hiring a virtual assistant versus an employee, because that could lower tax liability, or at least increase rates of return for an entrepreneur. So what are the kind of common themes that you hear that we talk about in my rooms, in my presentations, that you think are interesting and of note to entrepreneurs out there?
So what I definitely do here almost every time we have a room is everyone is interested about their business deductions and what they could deduct or not in their small business. So that's one of the items that we do hear a lot of questions come up often. Also, there are 401ks or Roth IRA. So those are things that usually do come up. Most of the time in our rooms, we are starting to have cryptocurrency rooms, which also are very popular. I think we did bring up or create a new crypto K plan, which also helps crypto into 401k. So that is starting to become very popular. So I think cryptocurrency is probably the number one item that we've been hearing, and just diversifying your portfolio. So those are many things that I've heard lately. Would you like to jump into some of those subjects?
Sure. I love the idea. So you brought up a very good point. A lot of people, when they come to our presentations, our rooms, et cetera, a lot of the time they'll ask about taxation of cryptocurrencies, maybe Bitcoin, Ethereum, altcoins, et cetera, et cetera. So why don't we talk about that? Very good point. Thanks for bringing that up. So people don't realize in the United States, all cryptocurrencies are construed as ready, real estate. That really is. At the end of the day, that really is the case. So I'll give an example. Let's say I buy a piece of real estate and I hold it for under a year, under 365 days, meaning, and then I sell it. So I buy it, let's say January 1st, sell it, let's say December 30th. What happens? As long as it's gone up, it's construed as property as a short-term capital gain. What does that mean? Wow, I could end up paying theoretically as high as 37% on the difference. So meaning as a tax, a capital gain, a short-term capital gain. That hurts, right? But at the same time, if I would have waited just a few more days, in that example, 2 days or over 365 days in my crypto purchase and selling of it, what does that mean? Again, it's just like real estate. So it would be construed as a long-term capital gain. What does that mean? Well, my tax rate right now in the United States would be a long-term capital gain, and I would pay that tax at up to only 20%. So which is better? 20% of the gain as to be taxed, or 37%?
I would take 20%.
Totally, of course. So that's all cryptocurrency is construed by in the IRS. It is just property, same exact thing as you hold a piece of property. You buy and hold it for over a year, and then you sell it. It's just construed as long-term capital gain tax at 20% versus, again, if it's sold under a year, if you buy and sell it, and that occurs under a year's time, it could be as high as 37%. So usually, generally speaking, one should contemplate when they're thinking about buying and selling cryptocurrency, they should look at the hold period, how long they're going to hold it. That's a big consideration as it comes to cryptocurrency. Now, mining, NFTs, et cetera, are a completely different area. If someone needs help on that, they can please get a hold of us at vastsolutionsgroup.com, or of course, they can contact me personally through my website, rkennerfrench.com. Again, rkennerfrench.com. We can talk about specifics. Reminding me, right now, it's a very important time to be able to say that we are doing this as an educational. This podcast specifically is educational in nature. We do not want anyone to take this as true investment advice. They should talk to their advisor, contact us via the websites I just mentioned, or who knows, do some more reading, make their own decision, but nothing should be based on this call. Okay, so you mentioned another thing, MJ. You mentioned 401k plans. Now, let's talk a little bit more about 401k plans. I'm sure you've heard during some of our presentations, we are big believers in 401k plans and other qualified plans. Now, in your estimation, why is it we are such big proponents of 401k plans and other qualified plans as it relates to retirement savings and...
Well, I am going to assume I'm thinking about my point of view. So, you for diversifying or having your plans to be able to um, I think we've mentioned before to be able to save on your taxes in order to put money into that 401k. I'm not sure what was the limit, but I think putting in as a limit also lowers your tax liability. I'm assuming that's what you're talking about. How about you let us know?
Yeah, that's exactly right. So as an example, a lot of people talk about IRAs. Sure, IRA, you can put away $6,000. That's great. But let's say on a 401k, let's say someone wants to put away maybe 3 times as much. Well, what's one strategy to increase their retirement savings outside of an IRA with low limits? Well, that'd be a 401k. In today's environment, today's IRS limits, you could put away $19,500, generally speaking, if you're below 50, $19,500, quite a bit more than the money you can put in an IRA. Plus, there's no income limits. So the nice element there is if someone wants to put away $19,500, depending on their tax bracket, they might be able to save as much as, I don't know, maybe $5,000 in taxes. What does that mean? Instead of at the end of the year having to write a check, or the beginning of the year, depending on when you do your taxes, instead of having to write the check to the IRS, instead the full money, $19,500, goes into the account. Right? You've gotten your deduction today, let's just say. And then when it grows tax-free. When you pull the money out, as long as you've abided by all the IRS rules, when you pull the money out, what happens? That's when you pay your taxes. Now, there's a strategy behind it. You can lower your net tax liability because you can strategically take the money out. But the nice thing is it's up to you. You could strategize when to take the money out. So let's go over that again. In IRA, you can only put away a little bit of money, right? Still, that's good. At least you've done that. But at the same time, in a 401k, you can put away up to $19,500 depending on your age. So what happens is, again, today you get your deduction. The government's putting money in your pocket by saying, here, you're going to put money in your pocket. Plus, you're not going to have to rely on the government potentially quite as much. And what would happen is down the road, or I should say every year thereafter, you don't have to pay taxes on the money that's in your 401k. When you pull the money out, way down the road, let's say when you're 65 years of age, or if you're doing it strategically, it'd be 65, 66, 67. That's when you pay your taxes. So it's a nice smart strategy versus an IRA, because you're getting your deduction now, putting in a lot of money, relatively speaking, and then every year thereafter, hopefully you're putting in the same amount of money, maybe $19,500, depending on what the IRS provides as limits. Grows tax-free, you pull it out. Sure, you pay your taxes, but you've been able to save money every year along the way because it's tax-free, and every year you put money in. That's why we are big proponents of 401ks. Now, also, there's other plans. There's profit-sharing plans. There's matches. There's so many different, there's so many different plans, but one thing to think about when you're talking to your financial advisor, tax advisor, etc., is a qualified plan. The power of qualified plans are something that a lot of people forget. when they're doing their overall planning as it relates to taxes and wealth creation. MJ, we were just in a room with our attorney, Greg Boots. He gave some great strategies surrounding 401ks. What did you think of what he was talking about? Let's shed some light on what he was talking about. He was talking about a strategy where you become your own bank. He was taking the position that, it might not make sense to actually have to go to a bank and ask for financing. Instead, maybe combining the idea of the 401k, getting your deduction. In my example, you save $5,000. And his thought was putting it into a customized insurance policy. What are your thoughts?
It sounded it sounded great. I was like, wow, that's a good return of what he's talking about, but I'm not sure if everyone could pull it off 100%. So I think there's some intricacies of that. So definitely sounded great, but I guess it just depends on.
Totally. It really depends on the circumstance. For some people, it works great. Remember, I was talking about an attorney a while back, and I'll just shed some light on this. Again, we're talking in the tax and finance room. We're talking about, strategies to lower your taxes and also hopefully some wealth creation tips on this podcast. What I would say is, if you put money into, let's just say, a qualified plan, in my example, you save whatever, $5,000. Using a general number, non-specific case, but you put away $19,500 into your 401k, you save $5,000. The government's basically putting $5,000 in your pocket because you're doing this investment in yourself, really. Well, Greg, our attorney again, what he was suggesting is, if you put that into a customized insurance policy, what happens is, that growth in effect, if it's a strategy that's outlined in his book, it's called the private vault. Basically what you're doing is when you pull the money out, you're acting as your own bank. You don't have to go to a bank for financing. You don't have to, go through underwriting at the bank. What happens is the money grows on a guaranteed basis. The nice thing is when you pull the money out, how does it come out? It comes out tax-free, almost like a Roth. Really, some people even say the analogy, it is a Roth IRA, because you put the money in tax, after tax, right? You've already paid your taxes, but then it grows tax-free. When you pull it out, it's tax-free. So it's the exact opposite of a 401k plan. Now, what I would say is, if you combine that with the deduction that you get in the 401k plan, the nice thing is you're getting the best of both worlds. So that's one other strategy that might be worth looking at, since we're here talking about, mitigating tax, lowering tax, and also increasing your wealth, that through, the combination of a qualified plan, getting your deduction, and putting it into let's just call it a Roth on steroids, that being a customized insurance policy that, in our case, Greg suggested, maybe along the lines of his book, again, called the private vault. Then it grows tax-free, you pull the money out tax-free, you get the best of both worlds. But again, what I would say is it really depends on the circumstances if this is going to work. It can't work all the time for you, but I would say is in many instances that maybe a portion of your portfolio should be in such a strategy, because potentially it can lower your taxes and increase your net worth. As we get ready to close up the room, MJ, what are some final thoughts about some of the things we've talked about, not only today, but just in general, as it relates to tax mitigation and also increasing?
I think one of the main things that I've heard just about in every room is how to create a small business to lower your tax liability. I think that is a great option. There's a lot of side businesses, especially during the pandemic. A lot of have been done or grown. So I think that's one of the items is get a small business in order to minimize your tax.
MJ, that's why you're so perfect. Nice. So appreciate that. So as an example, let's say I'm working for Google, or a friend who's working for Google. Anyone out there, right? There's not that many tax strategies you can employ, right? Because you're a W-2 employee. That's just the way the rules are for the IRS. Really, Congress put together our rules years ago really to benefit the small business owner. Most of Congress back in the day, when all these laws were enacted, for the most part, were made by business owners. So they really help themselves, but as a matter of fact, as a public policy debate, also helps, generally speaking, the United States machine forward. So really, as a result, it really makes sense to, invest in a business. So if you're working for Google, you want to, start a business. Let's just say, let's say you want to be a photographer. Let's say you're a great photographer, right? And on the side, you start let's just call it an LLC, whatever the case is, right? And then all of a sudden you start a website. So you start taking pictures, put them on the website and sell it. Hopefully you're doing this to make some money, really make some money. Who knows? Maybe it could be the next Google. I don't know. But at the same time, really what could potentially happen is, well, think of the following. Let's say you live in Seattle, Washington, as an example. You want to take some pictures of beautiful Florida. Well, let's say it's Miami, Florida. You make that trip down there, right? You've got a side hustle. You have a company that's hopefully going to make money by taking pictures, putting them on the internet. You end up flying down to Miami. What happens with the cost of that flight? Who buys that flight? Well, it's your company. Now, you're doing an investment in your company. So what does that mean? You end up getting a deduction on that flight. So it brings down the cost of the ticket of the flight. Same thing with your rental car. It's a business deduction, right? So your rental car, well, it's a deductible expense. The IRS construes that as a deductible expense. What about your hotel? Deductible expense. Well, what about gas? Deductible expense, right? You're starting to get it. So a side hustle is one way of, well, hopefully increasing your net worth. Who knows? Again, maybe you could become the next Google, but at the same time, it lowers your tax liability because you're investing in something. Now, there's a rule. It's called the hobby loss rule, as dictated by the IRS. You can't just be doing this for a hobby, really, just to get around paying taxes. You really have to do this as a go-forward company, or as the government would call it, a going concern. Now, the nice thing here is, let's just say you have, making up a number, $10,000 worth of expenses on this trip or any trip. And at the same time, you bring in about $10,000 of revenue. You end up netting, well, zero, so you don't end up having to worry about taxes. I'm being generic, very generic, but that's a nice element of having a side hustle with basically you just outlined, MJ. So that's not a bad idea. I'm glad you thought of that.
Thank you. And if you could shed some light before we close the room, of course, we've all been in a worldwide pandemic. Many workers have lost their W 2 jobs and do have a 401 probably tied in with their previous employer. What would you recommend for them to do in order to transfer that out to either a Roth or another 401k? Like, what should they do? What would be their best options, or how would they go about?
Woo, so many options, so many good ideas you've already come up with. There's two general options. There's a whole bunch of options. Obviously, if anyone has any real questions, specific to them, they could, check out our website at vastsolutionsgroup.com, or of course, again, rkennethfrench.com about specifics. Now, two ways. Number one, they can roll the money out. Let's say they were using Google as an example. They can roll their money from Google to their own personal IRA. Right? That's option number one. Oh, by the way, they can also parenthetically roll the money into a Roth IRA. At the same time, what they can also do is, well, let's say they have a side gig. Let's say that person at Google who's taking pictures had a side gig. If they want, they can roll over money to their 401k they set up at their side gig LLC that I mentioned earlier. What does that mean? They can have full control of the assets. Oh, by the way, they roll the money out from their plan at Google to their company's 401k plan. Nowadays, this is news. They can roll the money over into their 401k and they can invest those assets, their 401k assets, into crypto securities. We have a separate entity called cryptokplan.com, cryptokplan.com, where this is the first of its kind, first in the industry, allowing a 401k to invest in crypto. So that's just kind of the second option that one can do with respect to rollovers from, in my example, Google as an example, the 401k there, to their own LLC, and then they can invest those LLC assets in a 401k that goes into crypto. Again, great point.
Well, thank you, Kenner, for having this room. I do appreciate it. I think we got a lot of things out that we usually talk about. Hopefully, within other rooms, we'd be able to expand on what we've been speaking about. But again, great. Thank you for having this room, and thank you for.
Awesome. Once again, my name is Kenneth French. Run vastsolutionsgroup.com. A writer for Forbes. I'm a contributor for Forbes.com, and I run vastholdingsgroup.com. We're here talking about taxes and finance, lowering tax liability, increasing net worth. Once again, Kenneth French saying goodbye.